Trading currency on a 1-minute clock requires absolute precision, but most beginners trying to make quick trades on the euro to US dollar pair end up skidding off the edge, all because they treat a tool called the Relative Strength Index, or RSI, like a magic button. There is a common piece of advice. When the RSI line drops to 30, the market is oversold, meaning things are cheap and you must buy immediately. And if it hits 70, things are overbought and you should sell. That sounds easy enough, but in a fast-moving market, it often leads to disaster. A currency pair can stay in that oversold state for hours, with the price dropping lower and lower while your account balance disappears. To survive these fast markets, professionals stop looking at momentum all by itself. They pair that raw sense of speed with a clear view of the actual road ahead. To scalp with precision, you must match your speed to the reality of the road ahead. Think of the RSI like the speedometer in your car. It does a great job of telling you how fast you are going, but a speedometer cannot tell you if you are driving north, south, or off a bridge. When the RSI reads 70, it just means the price is moving upward at a very high velocity. When it reads 30, the price is dropping fast, or the buyers are totally exhausted. It is a measurement of energy, not direction. This chart shows our second tool, the Exponential Moving Average, or EMA. If the RSI is your speedometer, the EMA is your GPS navigation. It draws a smooth line tracking the average price over time, filtering out random, erratic bumps along the way. The math behind the EMA is special because it places a much heavier weight on the most recent prices. If the road suddenly curves, the EMA immediately bends to show you the new path. A standard average looks too far into the past and reacts too slowly. When you are making trades that last only a few minutes, the EMA is a mandatory requirement to keep up with the pace, because knowing you have a lot of momentum is incredibly dangerous if your GPS shows you are steering straight into a brick wall. This split-screen chart shows how traders get trapped. On the left, the RSI hits 30, triggering a beginner to buy. But look right, the EMA lines are in a steep dive. Buying here is catching a falling knife. The downward trend has reached maximum velocity. Institutional scalpers avoid this trap by demanding agreement between their tools. The speed on the dashboard and the map on the GPS must align before they even think about making a move. Acting on momentum without directional confirmation is a guaranteed way to wipe out a scalping account in minutes. This chart shows the proper way to set up your tools. First, we establish a safe road. We wait for a fast EMA, calculating the last 9 periods, to cross over a slower 21-period EMA. This proves the market is moving upward. Now comes the patience. We do not buy the exact second those lines cross. Instead, we wait for the price to pull back slightly, coasting down to rest on that 21 EMA line like a physical floor. While the price is coasting downward, look at what the RSI is doing. We don't want it to hit 30. We want it to settle perfectly on the midline, right at 50. That 50 level represents a deep breath. The market briefly took its foot off the gas pedal to rest, but the upward trend hasn't died. The moment you enter the trade is when the RSI bounces sharply up from that 50 line and the price holds firmly above your EMA. This alignment creates a high probability setup. You have directional support from the EMA and renewed momentum from the RSI, which helps you avoid false signals. Use the EMA to confirm the road is safe, and use that RSI 50 bounce to time the exact moment to hit the accelerator. This removes the emotional guesswork. You are no longer reacting to a single flashing indicator. You are executing a calculated plan based on physics and probability. Mastering these rapid timeframes requires reading every instrument on your dashboard together as one complete connected picture. Check your settings, calibrate your EMA periods for the specific currency,